What's going on, investing family? Listen to the Stock Market Tour Guide podcast, where I help you navigate the uncertain world that is the stock market. I'm your host, Stock Market Jay, and I'm here to save the day, bring you the news you can use with regular fundamental analysis, helpful insights, tools, and strategies. All right, guys. So, as a disclaimer to start every episode, like we always do, this is not financial advice. I'm not a financial advisor. I'm just an educated, active investor who believes in the power of proper education. Yes, I do believe that proper education limits risk and it maximizes profits. Okay, it's a proven fact. It's proven for me, and I feel like it'll be proven for those others that have taken the steps that have actually educated themselves. I've aligned myself with a few other investors, and they all believe the same thing, that it was the education, the information that they received with along with the education that propelled them to be able to be the type of investor that they are today, right? Um, you can't just wake up one day and decide you want to invest in the stock market and think you're gonna make money. You're gonna lose. That's not how you play the game. Just like you can't just wake up today and say you're gonna go get in the NBA. It doesn't work like that, right? You have to practice. You have to study. You have to put the time in, right? You have to master your craft, and then you'll be able to reap the benefits. And for me, and for those of you listeners, it's gonna be those profits, right? Maximizing those profits. So proper education does limit risk. And maximizes profits. I do believe proper education prevents poor performance in the stock markets and in everything you do. So this is an educational platform. So everything that I do, everything I say is going to be for educational purposes only. Remember that, right? But jumping right into it. So this is going to be one of those market sentiment episodes. Due to the fact that the CPI just recently came out, the Consumer Price Index, the PPI, Producer Price Index, and they both came in red hot, man. And the markets were actually affected to the downside today. Oh, it was blood in the streets today, man. It was ugly. Everything was down, due in part to the markets being forward thinking, right? The markets look ahead, and as investors, we have to do the same, right? So, with the producer price index coming out higher than expected, right? With inflationary data that came out in it, that the food is going to be up 0.8%, right? Energy is going to be actually down 2.1%, but overall, it's going to be up year over year. So we're going to have transportation services up 1.9%. We're going to have medical services up as well. And a lot of these are inflationary factors that investors have to deal with, right? We have a 6.92% on average increase in mortgage rates. Okay, rents are going up. The cost of living is going up. Food is going up. A lot of the things that we need to live our regular day-to-day life has gone up due to inflation. So the reason why the stock market is affecting to the downside, right? The reason why the markets are red today and has been red over the past week with all the information and new data that come out is because this is high inflationary data, right? So the stock market, Wall Street, is looking forward. Like I said, the markets are forward thinking, so the markets are looking forward to the next Fed meeting, and they are planning to raise interest rates by 75 basis points, right? That's what the markets are looking forward to. Yields are the highest they've been since 2008, which is going to be when the last recession was. So, of course, everyone's dreading the R word right now. But during this type of economy, that's to be expected, right? You have a bunch of geopolitical factors, as well as economic headwinds and tailwinds that are going to be affecting the economy, which is leading to the downside that we've been seeing in the markets over the last week, right? So you're going to have Saudi Arabia. They're going to be, this is going to be a geopolitical factor, of course. They're actually looking to side with Russia in terms of the oil. So they're pulling back on oil supplies, which is increasing the demand, and it's actually increasing the oil prices. So just like with the demand is increasing, the prices of the oil is actually increasing too. And that's going to lead to the higher transportation cost, I believe. Already with the supply chain restraints that we're still experiencing, that we have been experiencing, all of these things combined together are going to be leading to higher inflationary concerns, right? And that's what the markets are feeling. That's what the markets are looking ahead towards. the tech sector is always beat up the most, right? They're the most impacted sector in terms of a rising rate policy, right? That's just how it's always been. That's how it's going to continue to be. Um, it's a time where everything is affected by the things that are going on in the world today, right? The war in the Ukraine, that's affecting energy prices. Russia is one of the top suppliers in oil, so this is affecting the energy prices, right? It's affecting energy. Um, you have, of course, the United States is going to be because we're investing into the U.S. stock market, right? And of course, the U.S. it's a part of the geopolitical side of things, right? It's siding with, the Ukraine on the war of Ukraine. It's opposing sanctions to Saudi Arabia and Russia alike, and it's a lot of things that are involved in what affects the markets, right? And not only are we in a high inflationary time due to the quantitative easing that we had when we were buying up those bonds and putting it into the economy in a form of economic stimulus, now we're experiencing the quantitative tightening, which has those interest rates up, right? Which has car sales are going to be down right now because interest rates are high. The housing market is in a bubble right now because interest rates are high. And prices continue to climb. Prices are continuing to climb, so businesses want to make sure that they have the proper pricing power in order to capitalize on those higher inflationary times that we're in. So when inflation goes higher, that means the cost of goods and services goes up. And that doesn't only just go up for the consumer, it goes up for the businesses first, who first make the products and provide the services, and then they pass the pricing power, they pass that pricing increases on to the consumer. So you as an investor, you want to invest into a business that does have pricing power. Okay, you want to invest into a business that can survive and navigate through these high inflationary times, right? They can survive this because it's a whirlwind of things going on that's going to affect companies' ability to produce, right? To be able to keep those margins nice and healthy, right? To keep the cash coming in, right? To continue to beat earnings on the top and bottom line. It takes a lot to be able to do that during a time like this. You have to have the pricing power. You have to have the management team in place. You have to already have a cash loaded balance sheet. You have to have a solid business model. You have to have minimum debt or you're going to get eaten alive, right? You have to have everything has to almost be perfect during times like this in order to be able to continue to be a winning company, right? In order to continue to be a wonderful company. But the beautiful thing about that, or the inverse to that, is beautiful companies, wonderful companies strive and thrive during any economic times. You have companies out here that are still vertically integrating. You have companies out here that are still horizontally integrating, buying other businesses, because as businesses are going down and feeling the constraints, you have these larger, stronger companies that do have this cash on their balance sheet that are able to come in and buy these businesses up. And they're able to buy them at a premium now. They're still going to spend a hefty amount, but for what the business was worth at first, they're going to be able to come in and actually, make a nice acquisition, which is what cash is for. It's for acquisition purposes. It's for expansion. It's for, hiring new employees, more buildings and things of such like that. And during times like this, it makes it hard for the uneducated investor, right? Because if you don't know what's going on, all you see is this crazy news in the economy, and then you see stocks just going down. So you don't know how to navigate the markets. Because stocks are going down, you automatically assume that if you invest, you're going to lose. Well, I will tell you this. If you're investing right now, if you're doing the fundamental research, right, you can still be investing in a good company, but the stock is just taking a beating because of sell-offs, right? Because of capitulation in the markets, right? This is a very pessimistic market that we're in right now due to all the economic headwinds and tailwinds, the supply chain restraints, the quantitative tightening, the raising of the interest rates, which is like every time you get some news that comes out that leans towards interest rate hike, it affects the stock market, right? The geopolitical factors. It's a lot that goes into the world of investing that if you're uneducated, if you're not properly educated, you won't be able to play the game. You'll stay on the sideline, and if you do get in the game, you'll start maybe losing a little money, but you'll think that it's bad, not understanding that we are in a bear market, right? Knowing that in a bear market, stocks go down. Stocks go down and stocks go on sale. This is prime real estate for buying. This is prime buying opportunities right now. During this bear market cycle that we're in right now, this is a prime time to build wealth. This is a prime time to buy new positions, a prime time to add to current positions. This is a prime time to find plenty of value in the markets. And that's one of the key points that I want to get across right now. If you can continue to find value in these markets, you will not lose as an investor. Because if you can find a company that's cheap to own, if you can find a company that has low valuation, low price to book ratio, low price to sales ratio, low price to earnings ratio, it's selling it's selling well below its intrinsic business value, right? It's not selling at a 52-week high. It's not selling at an all-time high. It's selling actually at a 52-week low, or the lowest that it's been in 5 years, 6 years, things like that. This is where you find the value at, and this is where you find a safety net at during this time in the markets. The safety is going to be in the value, because in the next 2 to 5 to 10 years, you're going to get rewarded for your patience. One, for your patience. You're going to get rewarded for your ability to find value in these markets, and you're going to get rewarded for the emotional fortitude that it takes, the emotional intelligence that it takes to be able to invest in an environment like this, in a stock market like this, right? Because this is a very volatile stock market. But when you buy these positions, when you continue to add to these positions, and you get these rallies, your portfolio is going to balloon. When those stocks go back down, that's what you want to see, because guess what? It's time to go buying again. You just better hope you got some capital on the sideline that you can allocate into the markets, right? This isn't a time to be scared or pessimistic or negative on the markets. This is a time to be optimistic. This is a time to be greedy. The great Warren Buffett says, you want to be fearful when others are greedy, and you want to be greedy when others are fearful. So what that means is, during a bull market, everyone's coming in and buying up stock because the stocks are on the way up. No one's losing money. Everyone's making money hand over fist. Companies are doing great because chances are the economy is doing great, and then that just kind of trickles down. So everyone's greedy. So they buy into inflated stocks. They buy into overvalued stocks because they're not losing any money. But if you buy in close to a 52-week high, guess what? When the market finally decides to turn, you're going to be affected to the downside. You're going to be left holding the bag. Well, and so you don't want to do that form of investing. That's risky investing. You don't want to jump in when stocks are overvalued and inflated. That's not where the money is made. The money is made when you buy. So right now, when everyone is selling stock, when everyone's sitting on the sideline, when everyone's scared of this market right here, they're fearful. This is when all the deals are in the market. This is when it's time for you to get greedy. This is when it's time for you to have that extra cash that's just ready to be deployed into the markets, so you can eat up, you can eat greedy, you can just get nice and fat and get stuffed with all these nice cheap value plays that are in the markets. And then guess what? When the market finally turns, like it will, like I said, you have an inflated market, an overvalued market, which is going to be a bull market. And then when the market finally flips, which it does every so often, it's been like this since the beginning of time, since the stock market was created and officially founded. The stock market's been around for a long time. People have been selling stock in businesses for a long time, but officially, under the oak tree that they were under in 1929, in its inception, there have been plenty of bear market cycles in the stock market, okay? Sometimes they last for a year. Sometimes they last for 5 years. We had one that I believe lasts for about 10 or 15 years. That's how it works, okay? We actually just came out of one of the largest bull runs in history. It lasted about 15 years, since like 2011. Well, 10 years, about 10 to 11 years. We had a very long bull cycle. So when you understand that when people are afraid to put money into the markets, when people are selling stock, when people aren't looking to be a player in the markets, that's when that capitulation happens. That's when those sell-offs happen, and that's when stocks lose value. Stocks lose value when people sell. Okay, they don't lose value because people are buying them up. That's when the stocks become inflated and overvalued because everyone's in the markets buying them up. But see, you as an intelligent investor, you have to understand this. If stocks are up If one sector or one group of sectors is booming, that means another group of sectors is at a bust. It's contracting already. It's at a bottom. It's flooring, right? So if you understand this, then that means I need to be over here shopping in these sectors that are busting, that are flowing right now. I need to be taking my profits over here in these sectors that are booming, but I need to be taking those profits and I need to be putting them into these sectors that are in the bust right now, because that's where your money is made. When those companies are low, when those valuations are low, when those stocks are beat up on the other side of the fence, that's when you make the money. You make the money when you buy, not when you sell. Because if you buy at a low enough valuation, at a low enough price point, when that stock finally appreciates in value, guess what happens? You maximize those profits. That's how you limit the risk, by buying it cheap enough, buying it at a low enough valuation, buying it at a low enough price, and then you maximize it by selling when it's selling at a premium. That's how you do it. So when stocks are over here booming, stocks are going to be over there bottom feeding, and you need to be over there scraping the pot. You need to be. That's how you run the bag up in the markets. Not over here getting into stocks that have been going up and selling at a 52-week high. They've been going up for the last 6 months, and they're selling at a 52-week high. The stock is up 40% over the last 3 months, and you buying into it. That doesn't make sense, right? And this is how you play the game. And that's what I'm here to teach. Okay, I'm here to teach, and I'm here to help educate everyone on how to on proper investing fundamentals and how to play this game, how this game is played, and how the game is won. So I encourage everybody, like I always do, follow me on all my social medias. Follow me on Facebook, Stock Market J. Follow me on Instagram, Stock_Market_J. Follow me on Twitter, Stock Market J1. Subscribe to my YouTube channel, Stock Market J. If you're new to investing, definitely grab my book, Beginner's Guide to Stock Market Investing. It's going to be on Amazon and on Kindle. It's an ebook. Feel free to grab that. Add me on Patreon, Stock Market J. I'm here to answer any questions. I'm here to. I have a wealth of knowledge that I want to give back to the investing community. Okay, so if you want to get your feet wet, if you want to get in there and you want to do it the right way, you need to hit up your boy Stock Market J, and I'm going to be here to save the day. Until next time, investing family, peace.